take a look at an example of calculating an asset turnover ratio. And in this case, we're going to calculate the ratio for inventory turnover, the inventory turnover ratio. We need an example, and we'll start with two stores selling shoes. They each sell 1,000 pairs per month evenly throughout the year. All the shoes sell for $90 per pair, and all cost the stores $50 per pair. So I have the example set up now on the screen, and let's take a look at it piece by piece. First, notice the columns. We have a column that's labeled each, a column for store 1 and a column for store 2. The first line says the sales per month in quantity, so both stores 1 and 2 are selling 1,000 pairs of shoes a month. That equates to sales per year of 12,000. So 1,000 shoes per month times 12 months. And from this we can calculate the first part of a very simple profit and loss statement. We have the revenue, which is $90 per shoe times 12,000, and we have the cost of goods sold of $50 per shoe times 12,000 shoes. And we can see that both stores 1 and 2 have the identical profit and loss situations. Alright, so that's our basic setup. Let's add the next variable. In our next variable, we have store 1 buys all their shoes at the beginning of the year. Store 2 buys their estimated 1 month sales at the beginning of each month. So store 1 is going to buy all 12,000 pairs of shoes on the first day of the year. Store 2 is only going to buy 1,000 pairs of shoes at the beginning of each month. And as you'll see in a moment, there's going to be some borrowing involved by the stores to make this happen, and we're assuming their cost of capital is 8%. Let's take a look at what their borrowing does to their costs. Store 1 is going to have to borrow $600,000 right from the get-go. That's the 12,000 shoes times $50 a shoe. That's what they're going to have to pay to buy those shoes. And let's assume they pay in cash all up front, and that they have no idle cash sitting around. They're going to have to borrow the full amount. So store 1 is going to borrow $600,000. Store 2 has to only borrow $50,000. That's 1,000 pairs of shoes at the $50. So store 1 is going to have to borrow 12 times the amount of money that store 2 is going to have to borrow in order to subsidize its inventory. Well, let's calculate their cost of capital, and since we want to do a quick and dirty calculation for the year, we want to find the average balance owed during the year or during the month. So store 1, if they start with a debt of $600,000 and assuming they pay that down evenly throughout the year, they'll have an average balance due of $300,000. Store 2 starts at the beginning of a month with $50,000 owed, and they pay that down gradually to the end of the month to zero, and then they borrow another 50, pay that down gradually, and then they borrow another 50, and so on. So their store 2 is going to carry an average balance of $25,000 in debt. Well, let's calculate that at the 8%, and we see our cost of capital is $24,000 for store 1, $2,000 for store 2. So store 1 is bearing a much higher interest cost than store 2 is. Well, let's now factor this into their profit and loss statements. So the final activity statements, including interest expense, and I'm referring to this as an activity statement because of a class that I'm teaching in nonprofit financial reporting, and an activity statement is the term that we tend to use more often than an income statement or a profit and loss, but either is fine. So let's take a look at what this final activity statement looks like. Down to the margin line, nothing has changed from what we saw earlier up top. But I've added a new line. I've added a new line that says interest expense. So store 1 is factoring an interest expense of $24,000. Store 2, there's a 2. And we come down to the new net. Store 2 is much more profitable to the tune of $22,000. So now we have our basic data. We understand how the borrowing is going to vary between the two stores. We know what their cost of capital is. We know what their net cost is. Let's calculate their inventory turnover. And I've got this set up already, and let's take a look at what we have now. The basic calculation for calculating the inventory turnover ratio is we take the cost of inventory, their cost of goods sold, and their cost of goods for both stores. They both sold the same amount of shoes during the year, so they both have $600,000 of cost of goods sold for the year. We can see that on the income statement on the line that says COGS, cost of goods sold. So they're both the same. Now we're going to take a look at their average inventory. There's two ways of calculating this. And one way is to just use the inventory at the end of the period. Another is to take their average inventory. So let's start first with average inventory. So I'm going to type in the word average. So the average for store 1 is $300,000. They started the year off with 600, went down to 0. The average for store 2 is $25,000. We divide the cost of inventory divided by the amount of inventory, and we calculate the turns. So store 1 has a inventory turnover of 2. Store 2 has an inventory turnover of 24. Now, with all ratio calculations, we have to be careful about the results. This might not seem intuitively correct. Store 1 sold all their inventory and bought new inventory presumably at the beginning of the next year. One might think the inventory only turned over once. Store 2, well, they're every month they are selling out their inventory. One would think that their inventory would turn over 12 times. So we're going to make a simplifying assumption, and we're going to assume that store 1 replenished all of their inventory on their last day of their year. So they bought another $600,000 of inventory on the last day of the year. So they started at $600,000, they ended at $600,000. So $600,000 average inventory, and the same simplifying assumption for store 2 that they bought their inventory for the first month of the next year on the last day, so their average inventory is $50,000. In a future video, we'll explore how one must be careful to make appropriate corrections to ratios in order to get results that make sense. Let's stick with this calculation of turnovers. Store 1 having a turnover of 1, store 2 having a turnover of 12. And we can now begin to see some logic behind the importance of calculating the inventory turnover. Store 2, which has a higher turnover, has a lower cost of capital. It would seem logical that the more often you're able to turn over your inventory, the more efficient you are. You're not carrying around lots of excess inventory, and you have a lower cost of capital. So increasing your turnover would appear to be a very good thing to do. There's one more related calculation to the inventory turnover, and that's to calculate the days of inventory on hand. And intuitively, we would expect, we know the answers to this, but let's take a look at the calculation. The calculation for days of inventory on hand, we take the days per year, and days per year is 365 days per year. We divide it by the turnover. So the turnover of 1 for store 1 and turns of 12 for store 2, and we divide, and from that we can now calculate the days of inventory And store 1 starts the year off with 365 days of inventory. Store 2 starts the year off with 30 days of inventory. Now, interestingly, if we go back and we change our calculation to the average, which is probably the more correct way to do this. So I'm going to put the 25,000 back in for store 2, 300,000 back in for store 1. We have here days of inventory 183 and 15, and that actually does make more intuitive sense than on average during the year. Store 1 has 183 days of inventory on hand, and on average for store 2 they have 15 days of inventory on hand. All right, so simple calculation of inventory turns, and as long as you're consistent with how you calculate it, you can still see that store 2 has 12 times the inventory turns of store 1. So whether we're comparing 1 to 12 or 2 to 24, as long as we're calculating it on the same basis, we come up with a logical way of being able to compare the performance of store 1 to store 2. Now, beyond the calculation of ratios, one must also take into account when doing financial analysis that there are a variety of non-financial factors to bear in mind. Store 1, for example, presumably needs a bigger facility in order to house all of their shoes. If they're going to buy a whole year's supply of shoes up front at the beginning of the year, they are going to need more space to store all of that inventory. So because they're going to need more space, one would think that store 1 is going to have a higher cost for operating their facilities. Store 2, on the other hand, less space is needed. Presumably they have less expensive rent or other costs for physical facilities. So store 1's at a disadvantage there. But store 2 is at a disadvantage too, potentially, because carrying a lower inventory means that there is a higher likelihood that store 2 could be out of stock. Shoppers might come into store 2 and they might ask to see a particular pair of shoes, and store 2 might be out of stock. So store 1 is in a better situation with regard to out of stocks possibilities or out of stock situations. Store 1 having lower probability of ever being out of stock on a particular shoe. So financial analysis with ratios is not the end of the consideration. It's merely part of what one really needs to consider when analyzing a set of financial statements.